On Friday, December 20th, SPY rallied over 1% in just 3 hours, causing many call contracts to multiply 10x and some even 15x. What if I told you this move was predictable and you could have turned $1,000 into $10,000 or $100,000 into $1 million? If that sounds like something you'd like to learn, stay tuned because I'll be going over everything. Nothing I'm about to share is financial advice, so please seek out a licensed financial advisor before making any financial decisions. Welcome back, Cool Cats. If you want to catch huge and rare moves like these, you have to make sure there's a high level of confluence. And what that means is numerous supporting factors have to align all at the same time, giving you confidence to catch such a move with big size. So let's dig into all of the many reasons the market was likely to rally on this day. SPY was touching the daily support of the Ichimoku cloud right around 581. At the same time that QQQ briefly kissed the main support line around 506, and that support line in orange goes all the way back to January of 2023. Support and resistance on the daily time frame or higher is very significant, and support is even more relevant in a bull market. So long as it is tradable, there is always a level at which a stock becomes attractive to most buyers. If you're interested in what the Ichimoku Cloud Indicator is and how to use it, please check out my how-to video linked above, then come back to this video for more insights. That video also covers the RSI, simple moving averages, VWAP, supply and demand zones, support and resistance, and patterns. And if you'd like an even more in-depth how-to video than that, please leave a comment and I'll definitely add it to my to-do list. To add even more confluence, look at SPY on the weekly time frame. If you've been following my channel, you know that I'm a big fan of the RSI, and look how we had resistance up here, support down there on the RSI on the weekly. The RSI got down to the support line on this, further adding the likelihood that price was going to get a bounce. Now, if you look at this line here, this was the pattern target, which was targeting somewhere around 591 to 592. We took that measured move from here and moved it over. Now, notice how we actually went beyond that pattern target, and that tends to happen. The bigger the pattern target, the more likely it actually is to overshoot it because of momentum. Take a look at the 0 DTE 584 strike calls for SPY. We started the day, you could have entered around 100 to 130. We had the initial small breakout with a pullback, and you had multiple chances to get in before this big breakout. Pretty decent pullback here. We had a bit of a double bottom. We had another few impulsive moves up. And by the middle of the day, we were already up over $1,100 a contract. So your initial investment of around $100 could have 10 or 11x'd. And notice also how on the RSI, we had this bearish divergence here, the lower high versus the higher high, right around the same time that SPY was hitting the previous support line of the ascending channel that it was in, now seemingly acting as resistance. And this was also around the same time that Dixie hit the baseline of the Ichimoku cloud on the 4-hour time frame. These are the kind of outsized moves that can just grow your account exponentially if you can catch them on a regular, consistent basis. When we look at Dixie, the dollar strength index on the 2-hour time frame, we see that it had hit the upper resistance line of the ascending channel that it had been going in for 2 weeks, somewhere right around 108.50, and was rejecting sharply off of that. Considering it was a sharply rising Dixie that led to the market sell-off on Wednesday and Thursday, a sharply correcting Dixie should have had the opposite effect, and in fact it did. The VIX, by its very nature, is mean reverting, meaning that after every major spike, it tends to pull back down sharply, often leading to market rallies. After rallying to over 28, it was very likely to pull back sharply. And like they say, after the worst market days usually come the best performing market days. Even on the ADD, which is my preferred market breadth indicator, after the huge sell-off on Wednesday, December 18th, after Papa Powell shocked the markets by indicating a slowing down of interest rate cuts, the ADD was below negative 2,000, extremely oversold, and showing that the whole market was due for a bounce. On top of all this, on the daily time frame, SPY was well below the daily Bollinger Bands here, right around 588. It was all the way down around 581. And the final piece that really pulled everything together and made for an extremely high probability setup was that core PCE, the Fed's preferred inflation gauge, came in cooler than expected at 2.8% year over year instead of the 2.9% forecast, and 0.1% month over month instead of 0.2%, making it more likely that the Fed will lower the Fed funds rate. You must be able to make money when the market is going up and going down. If you'd like to know how you could have also caught the move down on Wednesday, December 18th, please check out my weekly market analysis video because the link should be showing right now. And please like, share, and subscribe for consistent market updates.